Hello everyone and welcome to part 1 of our series on different types of mutual funds. In our previous video, we discussed the 5 types of assets in which mutual funds invest. If you missed that video, you can find a link to the full mutual fund playlist in the video description and comments below. Many investors believe that mutual funds invest solely in stocks. They are unaware of other assets mutual funds can invest. As professional mutual fund advisor, this common misconception works to our favor. It enables us to guide our clients towards profitable funds, ultimately leading to satisfied customers. Convincing a client to invest outside of stocks can be challenging because stocks tend to outperform other asset classes over time. In this video, we will focus exclusively on stocks, and in the second part, we will take a look into the other asset classes. Mutual funds that primarily invest in stocks are known as equity funds or stock funds, and they come in 3 main types: market cap based equity funds, specialized stock funds, and thematic or sector based funds. Let's start with the first category, market cap based equity funds. Market cap based equity funds are mutual funds primarily composed of stocks, and they are categorized based on market capitalization. Market capitalization represents the value of company in the eyes of investors. There are 5 main types of market cap based equity funds. The first is large cap funds. Large cap funds invest in stocks of large, well-established companies with market capitalization exceeding $10 billion. These companies are often considered stable and less volatile. Less volatility means they are relatively less risky than any other market cap based mutual funds. But it's important to note that low volatility also means lower returns. In simple words, large cap funds carry low to moderate risk with lower returns. Second is mid cap funds. Mid cap funds focus on companies with market capitalization ranging from $2 billion to $10 billion. These companies are often in growth phase, offering investors the potential for higher returns than large cap, but with slightly more risk. Mid cap businesses are also known as blue chip stocks. The term blue chip comes from the game of poker, where blue chips are the highest value chips. Blue chip stocks can be good investment for those looking for safe and reliable way to grow their wealth over time. However, remember that no investment is completely risk-free. In terms of risk and profit profile, mid-cap funds enjoy the highest popularity among investors for moderate risk and high profit potential. Third on list is small cap funds. Small cap funds invest in companies with market capitalizations below $2 billion. These companies are usually in early stages of growth and they aren't well established, leading to extremely volatile prices. Due to high volatility, they carry high risk with high profit potential. Small cap funds can experience significant declines when the market goes into correction or crash phase. The fourth in line are multi-cap funds. Multi-cap funds typically have a fixed allocation to large cap, mid cap and small cap stocks. This means that the fund manager will invest a certain percentage of funds asset in each market capitalization category. Multi-cap funds can be good option for investors who want exposure to a variety of companies while maintaining some degree of stability. Their risk profile can vary from moderate to high risk depending on the fund's allocation across different market caps. The fifth is Flexi-Cap funds. Flexi-Cap funds, on other hand, have more flexibility in their asset allocation. The fund manager can adjust the fund's exposure to different market capitalization categories based on market conditions and their own investment strategy. This flexibility can provide more opportunities to generate returns, but also means that funds' risk profile can be more volatile. It's essential to note that while multi-cap and flexi-cap funds might seem similar on paper, but multi-cap funds generally carry lower risk than flexi-cap funds. Flexi-cap funds can experience significant declines when market goes into a correction or crash phase, whereas multi-cap funds tend to be more resilient. That covers market cap based equity funds. Now let's move on to the second category, specialized stock funds. Specialized stock funds are designed to meet specific investment criteria and focus on particular strategies or objectives. Here are some common types of specialized stock funds. The growth funds. The growth funds invest in businesses that are expected to generate strong earnings every year. Strong earnings are likely to drive prices up faster than any other asset class. However, these funds come with a risk profile that can range from moderate to high, offering higher profit potential, especially during bull markets. Next, we have value funds. Value funds seek out stocks that are considered undervalued compared to their intrinsic value. These funds are attractive to investors looking for potentially undervalued assets. They usually carry moderate risk because the stocks are less volatile. Profits in value funds are typically seen in long term and they can stand against bear markets effectively. Now we have dividend funds. Dividend funds invest in stocks of companies known for paying regular dividends. These funds are suitable for income-focused investors seeking a steady stream of income from their investments. Dividend-paying stocks are usually stable when it comes to market volatility and experience less beating during bear markets. Therefore, they carry low to moderate risk with less potential for capital appreciation due to income-focused investing. That brings us to third category, thematic or sector-based funds. Thematic or sector-based funds concentrate their investments around specific themes or sectors of the economy, allowing investors to align their portfolios with particular market trends or areas of interest. Two common types of thematic or sector-based funds include index-based mutual fund and sector-based mutual funds. Index-based mutual funds aim to replicate the performance of specific market index such as S&P 500, Nasdaq, or Nifty 50. Investors in these funds can gain broad exposure to entire index with single investment. Index funds are often considered among the safest options for investing in mutual funds. These funds replicate the performance of market index which tend to increase in long term. Next in category is sector-based funds. Sector-based funds invest in a particular sector of the economy such as technology, healthcare, or energy. These funds are suitable for investors who want to target specific industries. Risk associated with investing in these funds can range from low to high, depending on sector or theme. The performance of sector-based funds is closely tied to performance of the selected sector or theme. In general, you can find these type of mutual funds in every country with some variation based on local regulations. It's important to seek professional help while investing, as those who invest without professional guidance often end up suffering losses in funds where losses should be minimum to none. As a professional mutual fund advisor, I have gone training and cleared exams to earn my license, which I must renew every 3 years by taking more training and clearing more exams. This license, provided by Association of Mutual Funds India (AMFI), signifies my ability to help you profit in market. Unfortunately, some individuals do not seek professional help while investing. This leads to losses, which has created lot of negativity towards mutual funds. In conclusion, I strongly advise you to listen to your advisor. When it comes to mutual funds, following the advice of AMFI qualified mutual fund advisor minimizes the chances of making losses. In our next lesson, we will learn about remaining types of funds. In case you need our help to invest in mutual funds, then you can contact us using information in description and comment box. Let us know your thoughts about this video and have a nice day.